Coming into 2019, with the people that are new, some people have just started buying stocks, started buying investments, things like that. And their first question is, okay, so how does this affect my taxes? What do you have to say to that person?
Right. So yeah, there's been obviously some ongoing chatter and talk over the past year about the tax law changes, and it's not one size fits all. Every individual has their own personal financial situation, and it needs to be evaluated individually like that. But in general, tax rates have come down. We've heard that tax forms have changed, and I would say big picture items, exemptions and dependents were eliminated, and the standard deduction, has increased. I'm sure those are some very technical terms. So if there's anything you really, want me to explain, I'd be happy to help.
Once again, ladies and gentlemen, boys and girls, and children of all ages, welcome to the Prince of Investment right here in Honolulu, Hawaii, via Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button for everybody that's catching the playback on the podcast, YouTube, Facebook, Instagram, Twitter, or wherever else you may be catching this around the globe. Also, drop some comments below if you got questions, and also check out the description box to get in contact with myself or the guests and all the other great stuff. But as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So as you guys and girls can see in the description box, we got a very, very special episode today with a very, very special guest. We all know it's that time of year again. It is tax season. Tax season with everybody filing their taxes, whether it's a business, whether it's investments, whatever it is. But we have a new president in office, and a lot of things have changed being a tax season. We know taxes change every single year. But that's why I brought in a very, very special guest and professional, certified public accountant, Mr. Logan Howard, who's calling all the way from Pittsburgh, Pittsburgh, Pennsylvania. I almost forgot what state Pittsburgh was in for a second. But without further ado, let me introduce my guest. How you doing today, Mr. Howard?
I'm great, Prince. Thank you for having me. I appreciate the opportunity.
Awesome, awesome. Thank you for coming on today. So the first thing I want to do is for the people out there who don't know you or who haven't been introduced to you yet, tell us a little bit about yourself.
Yeah, so I graduated from a state school here in Pennsylvania, and then I graduated from the University of Pittsburgh with my master's in accounting. And I've been started out auditing, but I've been doing tax work. This is my fourth year doing tax work. I am a certified public accountant, and I do have my own business. So, and I'm also passionate about financial planning. I teach college accounting and tax courses at a local university and the University of Pittsburgh. So I'm pretty ingrained and entrenched in the accounting and tax community here in Pittsburgh area.
Okay, awesome, awesome. That's some great stuff there. Now, so by you having all your information and knowing all you know about taxes, coming into 2019, with the people that are new, some people have just started buying stocks, started buying investments, things like that. And their first question is, okay, so how does this affect my taxes? What do you have to say to that person?
Right. So yeah, there's been some ongoing chatter and talk over the past year about the tax law changes, and it's not one size fits all. Every individual has their own personal financial situation, and it needs to be evaluated individually like that. But in general, tax rates have come down. We've heard that tax forms have changed, and I would say big picture items, exemptions and dependents were eliminated, and the standard deduction, has increased. I'm sure those are some very technical terms. So if there's anything you really, want me to explain, I'd be happy to help.
Okay, when you say the standard deduction, what does that mean?
Yeah. So every individual, business owner, W-2 employee, automatically gets a deduction, and that is called the standard deduction. Last year, every individual, so just say a single person last year, they would have got just over $6,000 deduction right off the bat as a deduction. This year, that same individual that would have had that just over $6,000 deduction now has a $12,000 deduction. So the standard deduction increased from $6,000 to $12,000. And if you were married last year, filing jointly, so a husband and wife, they would have had 6 each, or a little over 6 each, so that would have been just over 12. This year, that same married couple would have they would have a $24,000 deduction.
Wow. Okay. So that means that all of the taxes that they paid, $24,000 will be taken down. Am I saying that correctly?
Right. So just say a married couple in 2019 or 2018, if they just say they, each made $50,000, they were at $100,000. So their taxable income would automatically drop from 100,000 to 76,000. They would only be paying tax on 76,000. The standard deduction would drop their income.
Got it. Now, for the people that are out there that are listening to this, that are everyday person, they have a 401k, they purchase some stocks and things like that. What are some tricks, or what are some ways to limit their tax exposure, aka pay less taxes?
Right. So I would say right off the bat, if you're an employee working for an employer, then you have access to a retirement plan, a 401k or a 403b if you're a government or a nonprofit worker. So I would encourage, employees to contribute the maximum amount or try to contribute as much as they possibly could to limit their taxes. That's pre-tax, that would drop their taxable income. And also, when you're contributing to a retirement account through your employer, you're deferring your taxes, but you're also saving, for retirement and investing for your future. And I wouldn't leave money on the table because a lot of the times your employer will match up to a certain percentage. So if you do not, meet that, if you do not meet the amount for them to match, then you're, losing money. You're leaving money on the table.
Okay, when you say I should put money into my 401k to avoid taxes, could you explain a little further? What does that mean? How does that work?
Right. So just say you, are making $50,000 at your salary, and you want to contribute to your 401k. So just say you try to contribute 10% of your gross income. So if you are making $50,000, you decide to contribute 10% of your income. 50,000 times 10%, you're contributing $5,000. So your taxable income would go from $50,000 to $45,000. So you avoid paying tax on that $5,000 that you contributed.
Awesome. Okay. So now you're explaining what we all know as traditional and a Roth. Out of traditional and a Roth, tax purposes, which one are you leaning towards, or which one you probably recommend for who?
Right. I get this question often, and I am self-employed, so, I face this question as well. And I'll tell you what I do personally and what I personally recommend. I have one of each. I have a traditional IRA and a Roth IRA. And just to explain from a tax perspective the difference, a traditional IRA, you get a tax deduction now for the amount that you contribute, and that grows tax deferred until retirement. And then you have to, and then in retirement, you pay income tax when you withdraw that money. So a traditional, you get a tax deduction now, and then you pay tax when you withdraw at retirement. And you have to keep the money in there until age 59 and a half. And that's the earliest you can take it, but then you automatically have to start taking withdrawals at age 70 and a half. And then on the other hand, you have a Roth IRA, and a Roth IRA, you do not get a tax deduction now. The money that you contribute grows over time, the money invested, and then when you retire, then you can withdraw that money tax-free. So essentially, you pay tax now, but you'll have tax-free income during retirement. Also, one thing that people do not know about the Roth IRA is you can withdraw your contributions tax-free, but if you try to withdraw money before retirement from a traditional IRA, you will be hit with a penalty. The reason I say to contribute to both is because, it's nice to get a tax deduction now, but it's also nice to have tax-free income in retirement. So, I like to, hedge my bets and diversify as much as possible.
Okay, so you do like a little mix, like a little bit into Roth and a little bit in traditional. Am I correct?
Yeah, that's what I do. And I sort of encourage other people to do that as well, because I would rather take a little tax hit now but also have that, the ability to withdraw the money if I would need it, but also have tax-free income in retirement. If you wanted a tax deduction now and tax was your main driver, then you would probably want to contribute the whole amount to the traditional IRA.
Okay, got it. Now you just explained about one of the ways that you can lower your tax exposure. There's a difference between tax evasion and tax avoidance. But one of the ways you can limit your tax exposure is by contributing to your 401k, because that money takes down your tax exposure. What are some other ways out there that I can lower my tax exposure?
Yeah, another way would be for a family, or an individual, if you don't have the greatest health plan, you can also have an health savings account, an HSA, and that money that you contribute to an HSA will also provide a tax deduction right now, and then that's also invested similar to an IRA. And then when you withdraw the money, you can use that money for medical expenses and medical purposes. So, if you plan on needing, having health or medical expenses, then you might as well contribute the money throughout the year because you will get a tax deduction as well.
Okay. So you're saying, okay, the HSA, the health savings account, is pretty much a way where you can put money up to the side that you can use later on for health expenses. Am I correct?
Yes, that is correct.
Okay. So that's another great way. You spoke about the 401k and the HSA, about ways to lower your tax avoidance. What are some other tips you got out there for under your sleeve?
Uh, you know, so about business owners. So, like you said, tax. The purpose of tax, is to lower your taxable income as much as possible. And as you said, tax avoidance is legal. I remember a professor I had. It said tax avoidance is okay, and we should play within the rules and be as aggressive as we possible. But it's not okay to evade taxes. Other things that I encourage for, like, maybe business. I deal with a lot of small business owners. Schedule C sole proprietors or single member LLCs. Legitimate tax deductions for them would be, I always tell my clients and myself, try to look for ways to maybe turn your personal expenses into business. So your cell phone is a normal expense that small business owners would have. So, then obviously you can get a tax deduction for your cell phone and all of the business miles that you drive. And business owners can also get tax deductions for if they're self-employed, their self-employed health insurance and a home office. So, whenever you are an employee, you are pretty limited. But as a business owner, there are many other tax deductions available to business owners than there are to employees.
Okay. Now you just explained about being about tax avoidance via being a business owner. So would that be something that you would advise people to, like, hey, if you are an employee and you're at home, starting a business is a way to help you lower your taxable income?
Yeah. First of all, without even talking about tax, just from like a personal finance perspective, I think we should strive to have multiple streams of income. Let's create as many streams of income as we have. So if you are a W-2 employee, great, but that doesn't mean you shouldn't be, have some kind of savings account and earn interest on your money, and also invest in stocks and receive dividends. And similar to that, then I think, having a side business, or as they're calling them now, side hustles, I think that's great. It's great to have another source of income, but then there is also, it does open the potential to maybe some other tax deductions that you may not be able to receive as an employee.
Okay. Now, when it comes down to when someone's sitting down with a CPA like yourself, how are you guys paid as far as, let's say, hey, I'm a small business owner or I'm a regular person, instead of going to the traditional HR block or going to the traditional Jackson, I can't even think of the name of it, but the other
Hewitt.
tax places, Jackson Hewitt, exactly. Instead of going to them, what are the advantages of going to a CPA like yourself?
Yeah, so if I'll start on the other end. So if you are going to some chain or franchise or just some local shop, they may have some experience, but in general, a CPA has to have education. There's an education requirement of being a CPA. You have to take 4 strenuous exams to become a CPA. So you also have to have work experience, work under a CPA, and then there is also a continuing education credit, so 80 hours every 2 years. So when you go to a CPA, you know that they have experience, you know that they're educated, and you know that they have to continuously keep up with the rules and laws. Whenever you go to a franchise, pretty much anybody can get a job there. I'm not trying to knock them, because I'm sure there are people that work there that have experience, maybe more experience than me. But I think the stress test for a CPA, it brings credibility to your tax profession.
Awesome. I would definitely agree. Now, most people now CPAs are. Do you guys? Is it a fee up front, or do you take a portion of the tax returns? What is the fee structure for hiring a CPA?
Right. So that, as you said, a fee up front. I think a lot of the franchises, they get paid from the refund. So I think a lot of people that are looking for a quick refund or just to have it done fast, they may go that route. Some CPAs will have a monthly retainer. For me personally, I just like charging a flat fee. Okay, so I'll charge so much for your tax return, and that's how much it'll be. And with that, I also, I give out a lot of free advice throughout the year. I try to be fair and reasonable. It is business. I have to run a profitable business, but I try to help people, and I want to be fair and reasonable for all parties involved. So I go by a flat fee model. Some CPAs probably charge a monthly fee in order for the client to have access to them. But I try to be open, honest, and transparent with my pricing.
Honest. Okay, okay. I like that. Now, let's switch gears here for a second, where we were speaking about the new tax laws. What are some things like you've seen all this craze about people saying, "Oh, this changed the tax law." Trump did this, the president did this, this new tax law. What are the disadvantages that are coming down, or is that just some rumor mill going around?
Yeah, so yeah, I've heard stories that refunds are less, and I actually just recently read one today. I saw an article. It said refunds are now more than last year. I think there has just been a lot of hype, way too much hype, you know, and so far in my experience, this is my second year of having my own business and having repeat clients. The repeat clients so far, most of them are in a very similar spot. I do not think the tax law changes are going to, be as big as they were talking about, the government was talking about, or other, commentators were talking about. I think people are going to end up very close to where they were. Now, like I said, it has to be evaluated on an individual basis because I'm sure that there will be people that see, big differences in both directions. But I think the vast majority of Americans that file tax returns are going to be in a very similar spot, just based on my experience so far this tax season.
Okay, because I haven't seen anybody. Some people went crazy about things like that. Now, it's some people out there saying, "Hey, I started investing into stocks. I'm earning dividends. My dividends are being reinvested. How is this going to affect my tax exposure? Is this going to, with these dividends I'm earning, I'm looking good. I own McDonald's stock. How's this going to affect my tax exposure?"
Yeah, so, in general, um, so dividends are taxed at a qualified dividends are taxed at a favorable rate. So when you receive dividends or capital gains from investments, maybe from a mutual fund or a stock, those are taxed at capital gains tax rates. And capital gains tax rates can be taxed at 0%, 15%, or 20%. So you could be earning dividends on a yearly basis and keep paying 0% tax rate on those dividends, depending which income tax bracket that you fall into.
Oh, so it depends on. So let's say if I get for my broker, I get my what's that? Not the 1090. Is it a
1099,
1099? I think it is. So I get my 1099 from my broker, and it says that, hey, you earned this many dividends, but you're saying, hey, I didn't earn those. I reinvested those dividends, and you're saying essentially it depends on your income tax level is whether you will pay stock, well, would you pay taxes or not, right?
Right, right. So when you so yes, from an investment perspective, I encourage reinvesting dividends because that's pretty much the compound interest effect. And when you reinvest dividends, your investments will eventually grow exponentially. But from a tax perspective, when you reinvest dividends, you will pay. And when I say reinvest dividends, so say you owned a stock or a group, you say you own so many shares of stock. If it paid you $100 in dividends, when I say reinvesting dividends, that means taking that $100 and reinvesting it back into that same stock. But yeah, so that $100 that you received in income would be taxable, and it could be taxed at a 0% income tax rate, 15%, or 20%. It would all matter into which tax bracket you fell into. But capital gains tax rate is definitely favorable and typically lower than income tax rates.
Got it. Got it. Okay. Now,
So,
um, when you look at $1 million athletes or $1 million celebrities or whatnot or whatever the case may be, and they're paying a crap ton in their taxes, what is advice would you give them, or what advice would you give them to kind of avoid taxes in their tax bracket?
right. So, that's definitely challenging. That's a good problem to have. And I don't
Yeah.
work with any professional athletes or entertainers yet, but
Hmm.
that's in one other complex. When I worked in Pittsburgh, I did actually work, with I would say like a professional football coach, and they have to file in multiple states. Their issues get very tricky. But as for ways for them to limit their tax, I think it just comes back down to the way any other employee would do that, and that is try to contribute as much as money to a retirement account as you possibly could to lower your you know lower your tax, your income, and also contribute to things like HSAs, or just try to defer taxes as much as possible. But there's really no way to you know just based on the normal situation.
Okay. So would you agree that the top three ways to kind of lower your tax exposure or avoid taxes is to one, increase as much as you can to a 401k, two, uh, put as much as you can into a health savings account, three, start a business.
Yeah, I would say those are three pretty good options. Yeah, off the top of my head.
Okay. So now, because I want some people to get out there because they always ask this question, and I know there are some celebrities and some athletes that have asked that question that are tuning into the show and watch and things like that. And they're like, hey, when I get paid, like you said, I'm paying taxes in every city. I have an away game in LA. I'm paying California taxes, Georgia taxes, this taxes, that taxes. So like half of my income goes to tax. So I thought it'd be very key in to hit on tax avoidance or some ways, some keys out there.
Right.
Now,
Definitely. I
one of the
mean,
things. Go ahead. Go ahead.
good. I'm good.
Okay, and one of the things I wanted to for you to expound on as well is going forward into the future, right? Would you recommend someone, for their kids, for their children? What are some of the tax advantages or tax ways when you start to think about children, if there are any out there?
Right. So, one thing that you could start to think about is gifting money away. It depends, because it depends how much, how many assets an individual has. If they're going to be, dealing with the estate tax one day, and some states have, inheritance tax, like Pennsylvania does. So at some point it may be favorable from a tax perspective to start gifting money away to your children, or maybe different beneficiaries, because that is a legitimate way to limit estate tax. You can gift $15,000 to as many individuals as you want, every year,
Huh?
and that is a way to transfer money without paying an estate tax in the future. And also, if there are wealthy athletes, entertainers, or whatever it may be, then you may want to consider to start a trust, because that gives you more control over how those assets will be distributed, and to make sure that the funds are in good hands to take care of your loved ones, family, friends, beneficiaries.
Okay, good stuff. Glad you brought that up. Quick question: can you explain out to people what is a trust?
Yeah, so a trust it's an agreement. It's a legal agreement where you pretty much are shifting monies to a fiduciary. Whether that's a bank, or some other company. So you're shifting money there, and that company is holding your assets, and somebody that works for that company, or somebody that you name, acts as a fiduciary, and that they are making sure that the trust agreement is being carried out as you wished. So there are different types of trusts, but in general, you're shifting money to a trust, and somebody, a third party, is watching over those assets and making sure that those assets and the income is being handled in the way that you wanted and you requested through a legal agreement.
What are the benefits of a trust? Why even waste my time shifting my money to a fiduciary? What are the benefits of a trust?
Yeah, so you can potentially avoid taxes, gifting so much money away every year. So there is a benefit from a tax perspective, but then also it's to make sure that, if a person died with assets, you may not have exact control over those assets. So whenever, you have that legal agreement, then you are ensuring that those assets and that income is being distributed as you wish. And my mind went blank here. There was also because when you shift those assets to a trust, those assets do not have to go through a will. They avoid probate. So it's a more secretive process to transfer assets. It's not open to the public, more private.
Got it. Because I always hear people say, trust fund, baby, and this is a trust fund, and blah, 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 blah. Like, why do I want to set up a trust fund? What are the benefits? So thank you for sharing that.
You're welcome. I'm no legal expert, and I'm no trust expert either, but I have enough knowledge to be dangerous, I guess.
That's all we need sometimes these days. But I did want you to share that, to put that out there. Now, for people that sit back and heard you this entire episode, and they want to know more about you, they want to follow you, how to get in contact with you, what do you have to put out there for them?
Yeah, so I'm a business owner. I'm a CPA, and I specialize in tax. So this is my busy time of the year. But I also enjoy personal finance and financial planning. I enjoy just helping people with all of their finances. I want to be here and act as a financial resource. Also, I do have a nonprofit, and it's called Project Financial Freedom. And I go into high schools in the local community, and I teach, personal finance to, high school students and even adults sometimes. I started writing a little bit for a personal financial company out of New York City. And other than that, you can find me on social media. I have a business page on Facebook. I have a website. I'm on Facebook, LinkedIn, Instagram, wherever. Just search for Logan D. Howard, CPA. And, happy to connect with anybody and help any way I possibly can.
Okay. Thank you for stopping by. And I wanted to say, is there anything you want to leave people out there with before we get out of here?
Yeah, so I always say, create multiple streams of income, learn the difference between a want and a need. I always hear people saying, I need this, I need that. No, do you need that, or do you want that? And live below your means, because if you do those, and simplify your finances, try to keep things as simple as possible. If you do that and you're disciplined and, and learn as much as you possibly can about your finances now, you're going to have a good future.
All right, Mr. Howard, thank you definitely for stopping by, and we'll be in contact. And for everybody that's out there, once again, this is the Prince of Investment coming to you live all the way from the beautiful state of Honolulu, Hawaii, via Denver, Colorado. Until the next video, podcast, cartoon, or whatever else you see we do crazy around the globe, peace, be safe, I'm out, and thank you.
Should I accept?